All right, good to see everyone. You should be able to hear and see the screen. Okay. How you doing, Sunil? And if everyone's ready, we'll get started. Okay. So we will spend about 45 minutes together today like we normally do. And if anyone wants to take all this, deeper, we do have the complimentary free workshops. Of course, everyone in this group would probably fit into the advanced workshop. And you can see the dates there. I don't deliver many of those, but I will be delivering, I believe, 2 of the 3 that you see on the screen there. So those are always free if you like. And with that said, let's dive into today's topic. And I thought, with all the FX Street sessions we do, it's usually a combination of, education and then application of what we're learning in the live markets. And I thought today we'd spend most of our time in the live markets, going over our topic. And so let's do that. Let me pull up the charts here. And by the way, hope everyone's doing well. It feels like it's been a while since the last session. Okay, there we go. Just getting the live charts up here. There we go. We're looking at the dollar. So before we dive into live markets, and I can look at any markets that you want to look at, but I want to talk for a moment about the strategy that we've always talked about here since day one at FX Street many years ago. And it ties right into today's topic. How do banks and financial institutions think and execute in the markets, right? What are the main things that they focus on? And, it seems like many people, well, first, it's pretty well known that the majority of active traders lose money in the markets. So be very careful, diving into this and risking your hard-earned money in the markets. I know we talk about that a lot. It's typically a part of our topic, right? But what I'm saying is, the reason why the majority of people lose money in the markets is because of how they think the markets and because of how they execute, right? Well, if you were starting a business, or if you think about any other business out there, like a Costco, a Walmart, a Goldman Sachs, Barclays Bank, any big Amazon, anything else, okay? If you think about how those businesses operate, that's how the financial markets operate. That's how, in other words, the big difference between a Goldman Sachs, right, or a Barclays Bank and Amazon or one of the big retail stores, Walmart, what is the big difference between how those businesses operate and make money? They focus on buying low and selling high, right? They also focus on marketing. Right? Goldman Sachs and the big banks around the world, they get the stocks and bonds, at a certain price, and they mark them up and sell them to others for a higher price. And they just do that, right, all day, every day. That's what they do. Amazon, Walmart, they get the products for a certain price, they mark them up and sell them at a higher price, right? That's what they do. Does that make sense? Now, I know these days online things are a little bit different, but the bottom line is how they make money is no different. It's just different products. And if a new, and for people that are new to the financial markets, it's so important that you think, you understand that how money is made and lost in financial markets, whether it's day trading, swing trading, longer term investing, how money is made and lost here in the financial markets is how money is made and lost buying and selling anything in life, right? If you're focused on buying things at lower prices or wholesale levels in, when you go shopping, well, why wouldn't you want to buy the dollar when it's down, or a stock when it's down, right? Or oil when it's down, or gold when it's down? Why would we think any different? Most strategies, trading strategies out there are lagging strategies that have people buying high and selling low. Does that make sense? Everybody understand that? Have you ever heard, and this happens, this tends to happen quite a bit, at least from my experience. Have you ever heard a new trader say something like, boy, if I just took the opposite side of all my trades, I would have so much money. You hear some people say, when I buy, the market goes down. When I sell, the market goes up. You ever hear people say that, right? Newer traders, they say that often. Well, why is that? Well, it's not some phenomenon. It's because most people are trained to be that last group of buyers. Most people are trained to be that last group of sellers. Take trend trading, for example. Let's say you have an uptrend underway, right? So instead of buying at demand, let's say you wait for prices to turn higher from demand, okay? And then you wait for that series of higher highs and higher lows, and then you buy. Well, who's going to buy from you? You waited for a big rally in price, and now you bought. Who's going to buy from you? In other words, never forget to ask yourself one of the most important questions when it comes to trading and investing. And, in other words, when you buy, who's going to buy from you? In other words, when you buy, are there others that are going to buy at a higher price after you buy? Because if not, there's really no other way to make money, right? When you sell short, others need to sell after you at lower prices, or there's really no way to make money. Does everybody understand that? And that's why we focus on buying as close to the turn in price as possible. That's why we want to focus on buying when the risk is lowest, reward is high, and probability is high. Okay. So, when you hear me talking about, or any of these YouTube sessions or FX Street sessions about supply and demand, wholesale, retail, all I'm doing, I'm just the messenger. I'm just trying to convey how markets really work, how banks, financial institutions make decisions and profit in the markets. And I started on that side of the business many years ago on the trading floor of the Chicago Mercantile Exchange, right? And so that's kind of where all of this comes from. I just trained my eye to see this on a price chart. So let's dive into our supply and demand strategy. And if you have a market that you want to look at, we can do that. Remember the strategy rules, we apply them equally to any market: stocks, futures, forex, options, real estate, bonds, crypto, doesn't matter. And any financial purpose: day trading, swing trading, longer term investing, you name it. So if you have a market that you want us to look at or want me to look at, just let me know. I'll pull it up and we will apply our supply and demand strategy rules. If you're brand new to this and this is one of your first FX Street webinars with the supply demand strategy and me, there are tons of videos you can watch where we go over that in quite a bit of detail. Of course, we never have time to go over all of the rules here in the FX Street sessions, but you can always come to those workshops if you want. All right. So any markets you want to look at, just type them in the chat and we can take a look. Otherwise, I have a pretty big list here we can go over. And all right. So why don't we start with the dollar? Okay. And as we apply the strategy and strategy rules, let's think like a bank. Let's think like a professional or a successful buyer and seller of anything, right? So where are market prices likely to turn, and where are they likely to move to? That's the question we are always applying our rules to answer. All right, when we look at the dollar is currently, let's take a look here. I'm sorry, this is the S&P. The S&P is slowly moving off of this demand zone. By the way, we have a position on here, full disclosure on that. But we can go to the dollar. I assume not everybody. Well, what markets does everybody trade? And then I can focus on those markets more. There's the dollar. Forex, equities, bonds, crypto, futures, you tell me. And we can look at, we have time to look at, that's why I wanted to start with the live markets today, so we have plenty of time to get to a number of markets, because we always run out of time. Okay, yeah, oil, oil's a good one to look at today too, because it did come into a supply zone for us, and it's rallying nicely off of demand. Actually, for oil, let me set this up. Let me share something with you here. So we do live trading sessions each morning. I deliver those, and let me get back to oil here. So this is all from this week, looking at oil. So oil came down to our demand zone, our qualified demand zone here, and you can see, we'll go to the live oil chart in a moment, right? But the demand zone had all the 4 criteria that we must have for it to be a qualified demand zone. Location of the demand zone was okay, not great. That's why it's a gray zone. And you can see price after, competition to buy at demand just pushed price a little bit higher, and then ultimately ended up close to 85, which is up in this area, right? Now, one of the things that is going to limit, or likely to limit, the gains in oil is if we go to, and I'm just going through your list there in the chat. Let's go to oil. Okay. So here it is. So there's that move off of the demand zone. You can see oil struggling up here. One of the big reasons is because it recently came into our larger time frame supply zone. Okay. So Andy, if we, right? So even though we had a small time frame demand zone, works out fine. This is most of the time going to limit those gains, right? And notice we've barely gone halfway into this supply zone, suggesting that big financial institutions, big oil producers have a lot of oil to sell up here around the $85 mark. Does that make sense? Now, if you want to see that supply zone, we can just scroll back and take a look. It's right back here. There it is. So here's the first one we are hitting. Okay. 84.25. We already hit that. And notice, once that zone was developed, we did have an initial quick pullback and price fell. So that suggests, again, that's the second thing there that suggests probably a big supply-demand imbalance there. Above that, just above $90 a barrel in oil futures, we have a yellow supply zone. So yellow zones mean good structure, good location. Remember, when we're quantifying supply-demand zones and we're focused on the real supply-demand strategy, the original supply-demand strategy, we're really focused on 2 things and 2 things only: structure and location. Those are the 2 pillars. Okay. There are tons of areas on a chart that look like supply-demand zones, right? But we ignore the vast majority of them. The reason is because there's not likely to be a big enough imbalance at those zones, right? We want to focus on supply-demand zones that are likely to have the biggest imbalance, because ultimately that's what causes price to turn. So let's keep going. All right, so watch for those two areas. And you know, if you're thinking of buying pullbacks to demand zones in oil, like that one, just remember we don't have a huge profit zone to the upside like we did a while back, right? Like back here, if you were in some of those sessions, down at 62, 63, you know, dollars a barrel, the profit zone was much bigger to 85. Now it's smaller. All right. That was a lot of time on oil, so let's move on. Just kind of going down the list here, so we'll kind of go a little bit all over the place. Looking at the S&P, let's go to the S&P, which is currently moving higher. So all that's happened in the S&P, and I can again share this with you from our live trading and analysis sessions. And again, if you come to those workshops, all of you will have an opportunity to join these sessions here for a week. So early in the week, let me kind of set all this up here for you. Carlos, I'll go back to that chart in a moment and explain it to you. So earlier this week, we had a demand zone come into play in the 30-year bond. That's not 30-year, there is no 30-year note, that's a typo. It's a 30-year bond. And notice when price came back into the demand zone and turned higher, right? When that was happening, we also had equity index markets like the S&P rallying into our supply zone. We're very big on inverse markets, very big on inverse markets, okay? Meaning if the S&P is coming into supply here, do we have an inverse market to the S&P that's coming into demand? And we did, we had the bonds, right? Makes for a higher probability opportunity. At the same time that the bonds were into demand, S&P into supply, we had oil coming, or I'm sorry, NASDAQ coming into supply, and a nice big drop in the NASDAQ from that area, right? So now that prices have come down, all that did was bring prices down to our larger time frame demand zone in equities. Does that make sense? Okay. All right. Okay, so now we would not, here's the thing though, going forward now, so all prices did over this week so far was move from our supply zone down to our demand zone. When I was on the trading floor facilitating institutional order flow many years ago, that's all that happened on the trade desk. We'd have big stacks of paper buy and sell orders back then, right? And all that would happen is prices would move from supply to demand and back again. Once all the orders were filled at a level, they would simply move to the next level. So that's all that's happening here, you know, looking at the charts this week, same thing. But now we would not expect prices to turn again at this demand zone, right? Just like we would not look to short another rally into this supply zone. Why? Because price went too deep into the zone. So there's not likely to be enough orders there to cause price to turn again. Does that make sense? So now price is likely to move out to the next set of areas, the next set of zones. And for that, we're going to go to another time frame here. All right, let me go to the, now you can see when we look at the 30-minute chart of the S&P futures, 45.77 is where there's likely to be, that's likely to be an area where there's a big supply-demand imbalance on the demand side, but I know that's quite a ways below current price. So if we go over to the SPY, which is the ETF for the S&P, and we go over to the 15-minute chart, you'll see a zone that's not too far below, okay? So 464.35, we have a demand zone there that will likely line up with bond market supply. So there's that there's that inverse relationship. Does that make sense? All right. Okay, good. Everybody good with that? So there's the next two, what's likely to be the next two demand zones below in the S&P. Now, there's a question in the chat, and then I'll move on to other markets. Let's go back and look at that oil supply zone. Okay. I think you were talking about this one, Carlos, right? That one. So this goes right back to the basics, which we can spend a few minutes on. And so notice that area there. You can see price is trading sideways here, right? For a very short period of time. 2 candles, that's it. And then price drops away. Understand the only reason why price drops from that level is because supply exceeds demand. There's no other reason. Could there be news associated with it? Perhaps, or not. But at the end of the day, that doesn't even matter. The fact is, price drops from that level because supply exceeds demand. Now the question is there a big enough imbalance here to cause prices to turn lower the next time it comes back to there? Okay. Well, we need to look at more evidence. One of the things we have is, notice 2 days later, price comes back to the level, you know, kind of touches it, barely goes into it at all, and then trades lower. And notice for the next week or so, oil is trading below this area. Think about it. A big market like oil, right? This whole week, right? Actually, this is almost 2 weeks of trading. All of this trading going on right here, but not one transaction up here in the supply zone. Think about that. All of that trading going on just below the supply zone. And then, but not one transaction, not one trade happens in the supply zone. What's the reason? It's because there's such a big supply-demand imbalance. Does that make sense? So when price comes back to the zone, we ask ourselves, who is buying here? Right? Whoops. Sorry about that. You know, who is buying here? Well, whoever is buying here is buying after a huge rally in price and into a price level where big financial institutions, big oil producers are likely selling oil. Okay? So anyway, that's the that's kind of the quick, short, simple version of why the chart was suggesting supply exceeds demand. And this doesn't look like a big move, but you know, 84 down to 78 and change, that's a pretty big move. Remember, we're looking at a daily chart of oil. All right, let's move on to some other markets. 72, let's see. You mean like this area here? That would not, yeah, that would not be a, yeah. So remember, we follow our structure and location rules. So remember, most things on the chart that may appear to be a supply or demand zone probably don't qualify as a supply or demand zone. All right, let's keep going. So let me just look back in the chat here. I know there were a number of markets. Okay. Yeah, so a few requests for gold, and then we can get on with some Forex markets. Yeah, we can definitely look at the gold market. We can look at gold futures, and we'll look at GLD, which is the ETF for gold. In fact, it's probably better to start with, I guess we could start with the gold futures. All right, so gold is rallying today, and silver is rallying today. We had a buying opportunity in silver as well. But we look at gold, we're looking at gold futures first. We are nearing the 1876 supply zone. Okay, and it's a little bit higher. Now notice, let me kind of point out another concept here. So even though the supply zone is up here, notice we have these sitting right here. You see how gold is kind of getting stuck here at this stuff? Well, the reason why we focus on the zone just above it is because think about it. When you think about supply demand zones, what most people think of is that they see a supply zone like this and their first thought is, I wonder if there's a lot of supply there, or I hope there's a lot of supply there. Try to think of it, maybe think of it this way. You want to focus on the imbalance, meaning, in other words, the greater, you don't need a ton of supply for prices to turn lower. You need a big supply demand imbalance, right? That's what matters. You could have 100 on the sell side and 90 on the buy side. You have a lot of supply, but you also have a lot of demand. You have a small imbalance. Or you could have 20 on the sell side and 2 on the buy side. Well, you have a lot less supply there than the first scenario, but you have a much bigger imbalance. Does that make sense? So it's all about the imbalance. Now, with this area right before the supply zone, think about it. If price ultimately gets up to the 1876, it will have had to go through this area first. Okay? To get through this, it's going to take quite a bit of buying, quite a bit of demand. Make sense? So if we do reach the 1876, because of these zones here, you're likely to reach this level now with a bigger imbalance. Okay? All right. So watch that in gold. And then on the demand side, we can stick to the gold futures here for a moment, and then we'll move on to the ETF. So much earlier today, gold was much closer to this 1803 demand, but now we moved away from that. So if we do come down to the 1803, we would expect prices to turn higher here. Remember too, what we haven't talked about and won't have time to talk about today is exactly, our specific rules for entry, stop, and target. Okay, but make sure you understand all that first, because we have to know, entry, stop, profit, target. We need to know that so we can manage risk properly. We need to know that so we know where the profit targets are and all that, right? All right, let's also look at GLD, which is the ETF for gold. There it is. I wanted to focus on one chart here. That is this one. I wanted to see if we're up into this area right here. Almost got through it, but yeah. So this is price is struggling here. So this is a gap up into supply. We'll see where gold goes from here. But anyway, there's that. So remember, the demand zones are lower, and in the gold futures, the supply zone is just a little bit higher. If you're not in gold, we can go to a smaller time frame, but you're probably going to have a big, nice footprint of supply right here. Whoops, these Skype calls coming in around 175.75. Okay, that is gold and GLD. Let's now go look at there's silver, but let's go over to the dollar. Yeah, silver has really gone from, here I can show you. Remember we looked at these a few minutes ago. Let's keep going. Let's look. There's silver. So if you trade silver, SLV, I believe this is yesterday, came into our qualified demand zone here. So this screenshot on the left, these are our live morning trading sessions. Again, from that workshop, all of you will have an opportunity to join these for a week or be in these. But anyway, notice the gap up from the zone. And again, when price comes down to the zone, think about it. Whoever is selling here is selling after a big drop in price and into a price level where price gapped up from. Understand that the reason why price gaps up like this is because of a big supply-demand imbalance. In other words, supply and demand is so out of balance here, you don't even get any trading till here. Okay, so that suggests a big supply-demand imbalance on the buy side here. Going back to silver, now we're looking at silver futures. All that's happened over the last few days is prices move from demand up to this supply zone, and it looks like we have a couple supply zones on top of each other. There we go. We do. The reason for the gray boxes or the gray zones is because, again, following our structure and location rules, these are, when it comes to location, they're not great. That's why they're gray. If they were in the prime location, they would be gold or yellow. The gray circle up there, that just means that's an off hours time. That's not in prime trading time, not during one of those sessions. All right, let's keep going. So that's gold, that's silver. Looks like, oh, Andy, I just saw your question in the chat. So again, we have very specific rules for entry, stop, and target. To your exit question, which is a profit target, we always, let's say you enter at demand, our rules have us exiting before the opposing supply zone, right? Typically, we go with about 80%, meaning whatever the available profit zone is, we take 80% there. That's where our profit target goes automatically. We want to take, we want to take the thinking out of this. And that's why we have really a rule for everything we do. Okay. So let's go back to the FX markets. And we can take a look at the dollar. And again, we can go to any possible market you want to go to, any stock, any crypto, what have you. There was a Bitcoin level that met entry just the other day as well. I think it was this week, but we can look in a little bit. Shiba, Brian, I don't have a chart of Shiba. I do not have a chart of Shiba, but some of the other cryptos though, let's see. I know we had, where is, so there's the last, so this is late last week. Bitcoin came down into our 58,850 demand, and we found that for our system that showed up on a pretty large time frame. Crypto today is just, Bitcoin right now is right up here, getting close to that 68,000 if it's not there already. But it's the thing is, whether it's crypto or an FX market or a stock or a commodity market like oil, it doesn't matter. Because what's exactly the same behind the scenes is it's just people making buy and sell decisions, right? That's all it is. It's just people making buy and sell decisions. And we know, so far, really the most profitable way to make buy and sell decisions is to buy at wholesale prices and sell at retail prices. That's how you make money buying and selling anything. So we apply our supply, demand, fair value, right? Our structure, location rules to the charts to try to figure that out. All right. Take a quick, oh yeah, so Bitcoin, yep, finally got through 68,000. All right. Okay, so we keep looking at the dollar, but we don't actually look at the dollar. Let's take a look. Price currently coming up to our supply zone. We've been here before. However, take a look. When I scroll left, we have a couple zones sitting on top of each other here. So one's a yellow, they're both yellow zones up there. So, and you can see price is struggling to even get through the first one here, right? See that with the dollar? So we're not even through this first zone yet. And then what's likely to be the higher probability zone is sitting right on top of that. So the dollar is also an inverse market to the stock market, major global stock markets. But when I say inverse markets, right, I mean when they reach opposing supply demand zones at the same time. So the presence of these supply zones up here are not necessarily bearish for stocks. If anything, they're more bullish. Does that make sense? Okay. So now for other FX markets against the dollar, it's really important to understand that we have these supply zones sitting just above, multiple ones. So that means we would look for, we'd expect demand or buying opportunities in FX markets against the dollar, soon. Nice profit zone to the downside in the dollar. We could stick with this chart right here, and you'll see below this whole fair value range, right? All of this novice space here, below all that, we have the 93.20 demand below, right? So that range is about 94, it's really about 94.50, 95 down to 93. And we are certainly near the upper part of that range. Now, we've been here before, so I wouldn't be surprised if the dollar, creeped higher to that next supply zone above, but ultimately likely to turn lower from that area. Now, look at some markets against the dollar. We can certainly go right to the euro. I know someone asked about the euro, or I think they did. Okay, so let's take a look. Let's look at we can look at the spot market. We can look at the FX futures. It really doesn't matter. They're all, it really doesn't matter. Anyway, let's take a look here, and we're going to look at this larger time frame. Will be our focus here. So just like the dollar had that demand zone below, here's the euro with a supply zone above the range, and then sitting just a little bit lower. I'll scroll back. You'll see sitting below current price. Right now we're at 115, basically 115.20. 114.52 is where we're likely to have a demand zone sitting down there, right? What we'll want to make sure though is if and when the euro does come down to that demand zone, that the dollar is up into that next supply zone. That's going to be key, right? We want to match those up. So that's that's some euro, likely some euro dollar demand down there. And if we go down here, again, this demand zone in the euros, just like that supply zone that the dollar's in right now. You're likely to go through that to the next area. But the 420-minute chart is a good one to watch. Let's go over to the dollar yen that has really been sitting in an area that we need to pay attention to. Not that zone. Actually, let's go to the yen futures if that's okay. I thought we had a big, large, yeah, here we go. So it's very important to know where the yen is at, bigger picture. And when we look at the weekly chart, there it is. Plenty of room down here to kind of wiggle around, right? A lot of room actually, but knowing that we're near a weekly demand zone that we've traded higher from, that's important information. Okay. So now coming to where is it? Yeah, that's important there. Oh, let's go to the Canadian. Right here. And we're going to go to the 4-hour chart. There we go. So this one's kind of just sitting in the middle. We're not going to spend much time here. But you can see the supply zone above, 8,200, and then the qualified demand zone below, 79.72. And for those that have either been through, the strategy stuff, I know I recognize a couple faces here, so I think some of you have, but it's all about structure and location. The key is to stay out of the middle. We don't want to be trading in the middle. We don't want to be taking any supply demand zones in the middle, nothing, because again, the middle, this area here, fair value, the novice space, whatever you want to call it, all of that trading activity in there suggests lots of orders are being filled, meaning there's not likely to be a big supply demand imbalance in there. Does that make sense? Okay. So we'll watch for that. That's the Canadian. We can also look at copper. Yeah, we can definitely take a look at copper. Problem, just looking in the chat. Let's go to copper. So we're going to look at 2 time frames here when it comes to copper. First, some overnight or off hours supply likely to come in around this 448 area. Again, notice it's above the range. Right? To follow our strategy rules, it has to be. Okay? It has to be. Let's also go to the 180-minute chart. And here, I think we'll see, there we go. So there are a couple supply demand zones to focus on. Here's 41.95 on the downside, and then 46.27 on the supply side. Right? And remember too, markets, any market out there, and I'm not just talking about the financial markets, really any market spends most of its time in the middle, right? Remember, the middle or fair value, that is where the majority of buyers and sellers agree to buy and sell, right? That's where the majority of buyers and sellers agree to buy and sell. So, that middle is naturally going to be a magnet for price. It kind of has to be if you understand how it all works. Correct, Carlos, but we apply the same, all we do is the workspace is different. So, but we apply the same structure location rules to day trading, swing trading, longer term position trading. Let's see. Right, so for like the S&P, as far as, we had a small time frame supply zone here that showed up, but that was against this larger time frame demand zone here, and all that's happening the last all week basically is prices just trading in between. We look to multiple time frames because you don't know where the picture is going to show up, right? It doesn't have to be those, Nico. There's actually 4 of them, right? We're just looking for that consistent evidence, the 4 components of structure, and then of course location. But I just noticed we are out of time. I just put a link in the chat. If you are, if you want to spend more time on all this, there's a link in the chat if you want to register for one of these advanced workshops over there on the right. These are complimentary, they're free. So we spend about an hour and 15 minutes or so. And okay, and again, if you need to make it easier, there's the link. You can just click on the link in the chat. And on that note, hopefully that was helpful, and we'll see you again at an FX Street session soon. All right.